Hey, good afternoon, everyone. Thanks for coming to this informal webinar. And what I wanted to do was talk a little bit about the dashboard that we're creating and about Right Line Trading's methodology, but really focus mostly on trading. Well, look at the E-mini move now at 4:30. And what I wanted to do, first of all, was to show you the trades that we took today in the live trading room. I have them marked on another chart, and I'm just going to put them in the room because we're going to talk a lot more about trading than we are about anything else. And when is a great time to trade and when is a great time to not trade. Now, everything's really moving here. And here's our first trade. Now, when I show you the trade, I'm going to describe exactly what the indicators told us. And what we're looking at here, because here was our first trade, was a long trade right here. Now, what this triangle tells us is that the market has a long signal out of consolidation. And the consolidation indicator, boy, the E-mini's taking a 5-point hit here. And here's the consolidation. It's right here. Here's the red line. Here's the blue line. And you get an automatic signal long right out of consolidation. Now, what made the trade so powerful is that it's coming off a dual support. Here's the modified 15, and here's the value area high. Now, let me just reload the chart for a second, because sometimes when you reload, when you reopen Ninja later, it doesn't show our background bias, which is really important. And hopefully I can get it back. All right, well, didn't come back there. Let me just try to, sometimes if you change the range number and then go back, we'll go back to 8, it'll bring the background bias back on. Because I want to tell you what we in Ninja, we here at Right Line look for on a trade, why we think it's important, and why we think that these are the most important independent variables required for you to obtain a successful trade. Now let me, all right, I might have to bring in a different chart here. All right, let me take this out. Actually, I'm just going to move it here. And here's the actual trade from the live trading room. Now you can see that background bias is green on the right edge. And this is my going over the trade in the trading room after we took it. Now, the green background bias, it tells us that what we have is a multi-time frame alignment of trend. And that's a very, very important independent variable, which we want to have in our direction before we take a trade. Well, the blue tells us we also have an alignment of our higher time frames to the upside, but it's not as powerful as the green. The green is a strong trending market to the upside on multiple higher time frames. And you'll notice the quant line. This line tells us that correlative markets are three markets that we anticipate that go up when crude goes up or goes down when crude goes up are moving in the appropriate direction. And what this is an assessment of money flow. I mean, almost the whole day in the market, what we're looking at is the sector rotation of a fixed amount of money. And institutions move it from high risk areas like crude, stocks, to low risk like bonds and notes and currencies. So what we look for is for the quant line to be with us, telling us that our correlative markets are with us. And the other thing that we look for is we want to get a retracement back to support, dual support, in a confirmed uptrend. Now we know the uptrend is confirmed because background bias tells us that we have an uptrend on two higher time frames. This tells us that what is very unlikely to be happening is that we're not taking a retracement, but we're taking a change in direction, that the market's going to continue down and eventually become a short. This tells us that the likelihood is extremely high that retracement back to dual support is going to lead to a continuation trade back to the upside. And that's exactly what we got. And the first trade, when we scaled it out, went 16 ticks. We're in one tick above the close, and the trade went up 16. Now, I could have taken this trade. This is a strategy entry. It also shows alignment on one higher time frame, but I don't like multi-candle retracements. I like to take single candle retracements. They have a higher probability of winning, and this one did go a candle and would have given us a successful trade. Now, on this 16-tick trade, we took it on 4 contracts. I took this trade long right here on 1 contract. It was a much, much riskier trade, but my anticipation was this was sort of a double bottom, the 2 green candles. Now, the modified 15 was yellow. We were really not in a trending market, but I did have the higher time frames. And you see on this candle, we added order flow and momentum, and this candle engulfed the previous candle. But it was still a much riskier trade, and we closed on a down close, or on this red candle, and we lost 9 ticks on 1 contract. Then we just waited, and what we got here let me take off all the stuff that I drew, and I look for these. Now, remember, all the time that I'm trading, we've got background bias green, which tells us that we have multiple time frames aligned to the upside. This is the best time to trade, and this is when the positive predictive value or the possibility of getting a successful trade is the highest, and we have the quant line. So what I looked for is a rising channel. Right here. When this trade closed to the upside, we were in 1 tick above. Our target was 5 ticks. We closed at 6. And it was a nice trade. It wasn't a huge winner, but it cleared everybody out of the first target. That was a $150 trade. And I think that was all we did on, I think that was all we traded on crude. And I'll show you then we had a trade here on the E-mini, which I'll show you, at 950. Let me just move crude back here. And then I'm going to move the E-mini in. Let me take out all of this. Now on the E-mini, the quant lines are really, really important. They're analyzing 9 markets, 9 correlative markets. Now the right edge tells us exactly where we were in terms of market profile and what we got. Now you can see to the downside here, if you try to trade without background bias right into market profile, this trade would have lost. This trade would have lost. They both bounce right off a market profile. We just wait for a better opportunity. And what we got right here was a move to the upside and then a pullback. It's hard to see in retrospect, but it was a pullback right to the value area high and then a trade to the upside. And this one went 2 points. So we had 3 winners on 4 contracts, 1 loser on 1 contract, and we made just under $500. But the thing that we stuck with today was that we always traded with multi-time frames in our direction. And on this trade, we had 2 of the 3 quants. As soon as we entered, we got the 3rd, and the trade went up 2 points. And we closed just under $500. And I wouldn't be surprised if there were additional trades. Now, this is an oversold signal. I'm not going to tell you we would have taken it because we would not have. All right, here's a lot of chop. Nothing to trade. And that's it. So really no great trade for the rest of the day on the E-mini. So what we're looking for really is an alignment of multiple higher time frames and an alignment of the correlative markets. Those are the 2 major independent variables that we look for on a trade. We don't trade into unbroken trend lines. We don't trade into market profile for the most part. The value area high or the value area low, which is here. If I squeeze it, or into the point of control. We look for a break and retest of those areas. And if we stay conservative, and actually this C candle here, well, I think this is at 16:30. It's pretty late in the afternoon, but you can see how great a trade this was. Up, back, again, dual support, and up we go on crude. And look at that move. Very late in the afternoon to take a trade on crude, but it aligned perfectly. And if you're trading later in the day, there's your trade. Now, what I wanted to do on what you see at the bottom of the chart, now I like to look at the 13 range as well as the 8. Whoops, this is still a 7. Let me change this back to 8. Is volume. And what we have is a very unusual volume counter because our programmer Leo was able to program a minute chart onto a range chart. And what this orange window, the orange box shows you, is the number of contracts crossing per minute. And I always watch that while I'm taking a trade. I don't want to take a trade in a dead market. I want to see at least 400 contracts crossing per minute on crude. I'd like to see at least 1,000 to 2,000 contracts crossing per minute on the E-mini. You can see right now in the minute that's passing us by right now, we're at 354 contracts per minute. Very, very light volume. Now, we have become very reliant on market structure, multi-time frame analysis, correlative markets, and we've really become nihilists when it comes to using additional associated indicators. We already determined that the stochastic indicator is useless. And what we've done, and what I wanted to do here at the bottom of the chart on these two indicators, what these consist of are 4 MACDs. These are the 2 higher, and these are the 2 lower time frame MACDs. One of these MACDs is your trading chart MACD in one higher time frame, and these are 2 higher time frames still. This is going to be a slow moving time frame, which we like to trade. We like to trade with the slow and get the multi-time frame, higher time frame alignment. But I wanted to see if they had any predictive value in helping us take a trade. And what I've seen is they don't really have any. And although the MACD system seems intuitively like it should be effective, the fact of the matter is it just doesn't help at all. If you look at the higher term MACDs right here, they're orange. We're looking for a crossover where the shorter term time frame crosses the higher term time frame, or if you're looking at a histogram where the histogram goes from 0 to positive. Here's the crossover right here. And you can see, whoops, it crosses over right on the, now on this candle, it does not cross over. It doesn't cross over until we get to this candle. And it's still to the downside the whole time here. Now the shorter term MACD is almost just completely tracing out what the candles are doing. If they're moving up, this moves up. You can see it's just swooping down. It doesn't have any predictive value at all either. And let's go back to our entries that we took this morning. We took this entry, and both our MACDs were positive. I'm trying to remember. I'll find the other trade. It was at 9:23. On 9:23, was right here. You can see that our shorter term MACD is crossed to the downside, and our longer term is crossed to the upside. So they just move willy-nilly, and after looking at these for a couple of months, we're going to discard them. The MACDs, even whether you look at too short-term or too long-term, really have no predictive value. What moves these markets are the correlative markets and the multi-time frame alignment and market structure. That's it. None of these are able to predict the future movement of price. And they have no future, they don't predict how price is going to move into the future. Now, let me just take a look at a couple other trades. Because really, this is where the pedal hits the metal, so to speak. It's how does your platform work? when you're trading. Now, let me bring the other chart in because it's got background bias and this one doesn't, and that's really what we want to look at. Let's move past this. You're going to see that the best trades occur when you have multi-time frame alignment. That's not to say that you can't get a trade where this is clear, where the time frames are out of sync, where maybe your longer terms are one's moving to the upside, one's moving to the downside. But if you wanted to find chop as the misalignment of higher term time frames without any synchronization, this area that's clear is the area where taking any trade is going to be associated with increased risk. If you want to take the safest trades, you're going to take the safest trades where there is multi-time frame alignment. Okay, here's a 13-tick trade. Now this is a riskier trade. No multi-time frame alignment, no background bias. This is a 25-tick trade. These were all taken in the room. The move down, the move up, the retracement right to resistance, and then the continuation down. And I'm gonna go look at questions in a second. Eventually we got the quants. But the major thing that moves the market is market structure, and these are definitely slightly riskier. But you can see that you have a nice downtrend. Now this was a loser I took, and it really was an awful trade because here the 50 is rolling, here the 50 was moving up strong, although the 15 had crossed the 50 to the downside, and this is a trade that deserved to lose. It was just a really, really bad trade. Let me just look at some questions because I want to take them one at a time. So you see, if you look at these three trades, I took a riskier trade at 25 ticks. I took a riskier trade at 13. And then I took a full loser. On balance, this full loser is going to take out a lot of probably 100% of the profit from the winner and some profit from the second winner. So you really, really want to stay conservative. You want to stay with background bias, and you want to stay with the quant line. And let me just go into and take a look at questions. Whoops. Let me just grab the questions again. I'm sorry. Okay, I see that, Alan. Yeah, Ron, and that's what we're going to do at the end. We're going to invite everybody in for a trial so everybody can come in and see how we trade. Doug, the way we found out which markets correlate was just trial and error, doing an enormous amount of work. I mean, what we would do is we would do 2 years of market replay data. I mean, you start off intuitively knowing that certain markets have a direct relationship and certain markets have an inverse relationship. You know, on the E-mini, because a lot of the stocks are the same in the E-mini and the NASDAQ and the E-mini and the Russell, they're likely to have a positive correlation of 0.7 or greater. You know that bonds and notes are likely to have an inverse correlation to stocks. So you get a launching point for some of the markets. It was much, much more difficult to find out the correlative markets for crude, which is why there's only one quant line, and we could only find 3 correlative markets. On bonds and notes, where the quant lines are super powerful, We got, and I'm going to show you these other markets. We got 6 correlative markets, but really it's just a matter of trial and error. A lot of them are currencies. A lot of them are precious metals. I can't tell you which ones they are because it took us so much time to find them. But that, I mean, that's kind of the key. Yeah, Ron, NinjaTrader is really the platform that it does work on. Well, Doug, what we found in terms of the correlative markets is that these correlated over a 2-year period at 0.7 or greater. And when you say that market correlations change over time, you're absolutely right. Sometimes these markets correlate as low as 0.7 and as high as 0.9. But we did not find them to fall below 0.7 for that period of time, or we would have eliminated them. I mean, there's some, listen, remember that really this is sector rotation. And it's the institutional guys moving money from high risk to low risk areas. The correlative markets, James, are markets. If you look at this, at trading in this way, and is that institutions are rotating their money around from high risk to low risk investments. Like usually when bonds and notes really move up strong, the E-mini, the NASDAQ, the Russell, and the Dow are really going down. So we know that those are 4 correlative markets. The only question is, like when institutions pull their money out of stocks, one of the places they put them in is bonds and notes. Another place they put them in is precious metals. Another are certain currencies. So what they want to do is they want to put them in safe haven markets. So that's really what we are assessing. What we're doing is assessing money flow. When you get 3 green markets, 3 green quant lines on the E-mini, it's a very, very powerful signal that money is flowing strong into the E-mini and to the markets that correlate with the E-mini when it goes up, or markets that correlate with the E-mini so that when the E-mini goes up, these correlative markets go down. And the correlation coefficient has to be 0.7, and they have to do it with correlate 70% of the time or greater. There's never going to be a 100% correlation. There's just going to be a high correlation. And if you wait for the quant lines to align, the probability of getting a successful trade just really becomes astronomically higher. If you look right here on this candle down, you have 3 red quants. And you're coming out of consolidation, that's the triangle. And bam, down you go. Correct. This is the E-mini, we trade on a 5 range, crude we trade on an 8. So if you have the patience just to wait, first of all, you need a good market structure set up. And what you do is you have the move down, you have the retracement into a confirmed downtrend. Now, I don't know what the background bias is because we closed and opened the chart, and unfortunately, I can't see it on this chart. But we've got the triple quants, which is what we're looking for, all 3 correlative markets to the downside on the entry. And the trade is a very, very nice E-mini trade. We're in 1 tick below. Plenty of room on market profile, and it goes 1.75 ticks or 1 3/4 points. And that is not a bad trade. Now, the thing that I just want you to understand is that in no way is the price of the E-mini or the price of crude affecting these lines. These lines are affected by other markets. So you don't see red because crude is falling. Crude is falling because this line is red. The same thing with the E-mini. You don't get these three quant lines green because the E-mini is going up. The E-mini is going up because these lines are green. That's what gives them all their predictive power. And the one thing that we found is that if you use an indicator that assimilates data from your trading chart, it can't possibly look out into the future. You've got to look at indicators that bring in data from either two things, other markets or higher time frames. And I don't care what that indicator is. The market profile that we use, right here, the value area high, value area low, the point of control. This takes a proprietary look back. It's not being jerked around by price that's forming on your trading chart today. We have it looking back a certain number of days. It makes it more stable, and what we're looking for is to trade with specificity, not sensitivity. We're not looking to get into all the moves that the market makes. We're looking to get into the successful moves that the market makes. And sometimes the market will make really big moves that don't correlate with our entries. The quants won't correlate, or background bias won't correlate. So we don't care about those moves. But when everything does correlate, and let me bring this over. So when we look at the E-mini, we can see what the background bias is, because I think that's important. Let's take a look at when we get all the really, really nice trades. Now here's a great trade off the right edge, right here. Now, I call these dual quants. Sometimes you can trade with two quants. And you can see this is a long period of consolidation. I think is the most powerful market structure set up on the chart. When you get a consolidation signal with multi-time frame alignment to the upside, and only have two of the three quant lines with you, it does add a small amount of risk, but this is when this trade's going to fly. Now, if you took the trade here, and there's really no reason not to, it's going to give you a lot of heat, but your stop is one tick below this line, and you never would have gotten stopped out. And this would have been a really, really nice move to the upside. It would have given you a little bit of acid indigestion, but it still would have been a successful trade. And at the end of the day, that's all that matters. So here's two trades that we took in the live trading room. And I took this trade here. I took the retracement. We didn't have background bias, but I love the triple quants. I had all the correlative markets in my favor. And the trade dropped from here to here, 2.75 points. Then I got a retracement. This was a much riskier trade. I took it on two quants. But I still had background bias. The candle was surrounded in red. That means we have order flow and momentum aligning with us. And it went down 3 ticks, which is our first target. Then I didn't trade again because I lost all the quants. I only had one. I don't want to trade with one. And look what happened to the trades. With the correlative markets, this is a loser. This is a loser. Every one of these trades without the correlative markets doesn't go anywhere. That's how powerful they are. We can look here. And that's your winner. And it occurs with background bias, candle surrounded in order flow and momentum, and you have all the quant lines with you. That's all you have to do is wait. Now, could you have taken, let's see on the right edge, this trade short? Yes. You don't have background bias, but There's enough independent variables going in your way, and you do have a nice strategy signal. So this is discretionary trading. What the software does is define risk. That's the most important thing. You want to know, is your trade risky or is your trade safe? Is it super risky or is it relatively safe? If you want every single independent variable to align, and some people don't have any risk tolerance at all, they're going to hold up on this trade. And if they miss this trade, so what? If you're trading a 25 lot or a 50 lot, maybe you want background bias, and you're not going to trade unless you have multi-time frame alignment and you have all three quant lines. That's fine. Remember, it's never wrong to miss a winner if you have a good reason for it and you're going to do the same thing every time. What's wrong is to take a loser on a bad trade when the system does not tell you you're taking a really, really safe trade. And if you look here, look what happens when you try to trade into market profile. You have a C with all the quant lines, right into the value area low. You know, and eventually it breaks and goes through, but it's very, very, very risky. Even with triple quants, I would not challenge the point of control, although this one broke it. Okay, here's one I took. These are all trades in the room. What I did was I took it on only one contract. We either trade 4 or we trade 1. This is a much, much riskier trade. And it was a pure market structure trade. And this was simply an engulfer off an area of resistance. It's engulfed. And I bet that we were going to get continuation right to support. And that's exactly how far we went. 5 ticks on one contract. Then we had this enormous trade. And what do? We got it on dual quants. Here's the move down. Here's the move up. This color of background bias is very powerful. Not quite as powerful as the pink, but extremely powerful. Pretty much we had everything we wanted here on this trade. And if you look, the candle's poking its way through the value area low. We're in, and the trade went 29 ticks, 7.25 points, because we waited for the multi-time frame alignment, and because we waited for the quant lines. 2 at first, and then as soon as we entered the trade, we got the third. And let me tell you, no MACD or oscillator that's chugging out data from this chart and this price is going to in any way increase the predictive value of these trades. There's no way. Now here is a trade that I took on a move up and a retracement. It didn't quite clear the point of control, the value area high. And I knew it had a lot of risk. I just liked market structure. And I didn't have the quants. And it pushed up a tick. And as soon as it started to come back, I closed it early. And we only lost 4 ticks on the trade. And this is a very risky trade. I did not trade with the quant lines, and it really was a suboptimal trade. The only thing that can be said about it in retrospect is I got out of it quick. I didn't let it come back 7 ticks or 6 ticks. It's actually 7 to take us out. Now, we get an enormous number of winners on the E-mini because the quant lines are so powerful. Now, here's another great trade. I mean, I could just go on and on here. I mean, it's very difficult when you have this dark pink background bias and triple quants to take a loser, unless the market is very oversold or very overbought. I mean, you can see right here that you've got 9 markets sucking money out of the E-mini. Money is falling out of the S&P, and it's falling out of the Russell. It's falling out of the Dow. It's falling out of the NASDAQ. It's moving into notes. It's moving into bonds. It's moving into currencies. It's moving into precious metals. And we know that because these 3 lines are red. And the chance that this is going to reverse on us right off resistance with order flow and momentum pointing to the downside are very, very slim, in addition to trade out of consolidation. So you just wait. Now, you could be hasty and take this trade. There's really nothing particularly wrong with it. We take it to the right edge here. Let's see what we got. Now you're trading into the value area low. When you trade into market profile, you want to trade out of consolidation. What we found is that consolidation has the power to break a value area low, a value area high, or a point of control. There is none here. You just, you have patience. If you want to risk the break here without consolidation, it would have taken you out by the wick, and then you would have had to re-enter here, and then you would have gotten the winner. So you would have had a loser and a winner. If you had the patience to wait and not worry that this is going to go on you, you get the more optimal entry and the winner to the downside. Now you can see during this period of time when there's no multi-time frame alignment and no quant alignment, this is when you just stay out of the market. And the one thing about the system in predicting risk, it tells you really right up front when you should just stay away and just sit on your hands. These higher time frames are not in alignment. The correlative markets are pulling money in one direction, pulling money in the other direction, and the E-mini can really do anything. And it's almost impossible to predict anything from this. There's no price action or market structure set up here, just nothing. And these are the times that traders do trade, and when they get chopped to pieces. Remember, 95% of day traders lose their money and lose their accounts. And I'll go back and take a look at the questions in a second. So there's a really good reason for it. And the reason is they're all doing the same variation of this exact same thing. They're all trading MACDs with different inputs. They're trading stochastics with different inputs. And then they're trading the Fibonacci myth, I call it. Because Fibonacci absolutely doesn't work. We've looked at 2 years of market replay. Sometimes Fibonacci levels hold. Sometimes they break. Fibonacci confluences do not work. I mean, think about it for a second. What you're saying is that these extensions or retracements out into the future are going to describe the movement of the stock market, when the guy who invented them, Fibonacci, lived in the 17th century. I mean, he never even did an experiment on the stock market. And the transformations that he developed, the mathematical transformations, really don't do anything. They're mathematical curiosities. For us to make the assumption that somehow these set of numbers are going to describe the future movement of price is ludicrous. And when we looked at it in 2 years of market replay, it was valueless. And the same thing with Elliott wave. We use a small component of Elliott wave in our system, but there's software that does look at Elliott wave. And I actually like the software. It's called MT Predictor. But basically, it's a 50-50 system. And they'll admit it. 50% of their trades win, 50% of their trades lose. And the way you have to make money on the system is to let your winners run a long, long way. And that's not the position we want to be in. None of their entries can tell you whether they're low risk or high risk. They don't define risk. They don't tell you what the sensitivity, specificity, prevalence, or positive predictive value is on any given trade. Well, all of our trades do. They define risk for us. And look at this trade. I mean, this is on dual quants out of consolidation. I mean, if you don't take this trade, look at how long consolidation is. And I just want to talk to you for a second about consolidation and why it's so powerful. What it's doing here is here's a bunch of traders short. Here's another bunch of traders short. Here's a third group of traders short. Here's a fourth group of traders going short. And then we have one group, two groups, three groups of traders going long. So we have an enormous number of traders with a lot of contracts in this little band. Now, if the trade becomes a counter trend trade, which is very unlikely, you're going to stop out all the shorts. Almost always, consolidation breaks out into the direction of the trend. And you have dual quants here. You have lines 1 and 3 telling you that you have good money flow out of the S&P. Multiple higher time frames are to the downside. You're coming out of consolidation. You can see that the candles outlined in red, which tells you that order flow and momentum are aligned to the downside. And then this trade is propelled out because you got three groups of traders long that all get stopped out as the move goes. And that's what we look to do on every trade. We look to take advantage of the traders who are, listen, what are these guys saying? They're saying, you know what? I'm going to call a bottom here. I'm calling a reversal. This is, as far as I'm concerned, how low crude is going to go. Whatever software they're trading, their software is telling them, here's the place that crude is going to form a bottom and start moving up. They're counter trend trading, and they are calling a bottom. And let me tell you, that is a disaster. And these people who do this are all going to get killed in the long term. You have to be trend traders. And I just want to say something really quickly, and then I want to show you the dashboard. Remember who sets the trend. It's the institutional guys. It's the big traders with the big money throwing in tons of contracts. When they have the market moving to the downside, you don't try to fight them. You look for a safe place to get in and go with them. If you try to beat the institutional traders, you're really going to get taken to the woodshed, as they say. Now, the only other thing I wanted to mention was one of the traders we have in the room sent me an article about high-frequency trading and how high-frequency traders are privy to data that really nobody else is privy to. And what they look for are areas in the market that when they turn the market or they continue the market, they cause the most amount of pain to traders because it's advantageous that your entry and the continuation of your entry stops out as many people sitting in the counter trend position as possible. You're not being mean. We're in this to make money. And when you can run over 3 up candles in a single move, these are the kind of things that HFC traders will look for. Now, they can actually see where people have placed their stops. So they have a very, very unique advantage, and they have the power to just turn the money on turn the market on a dime, which is why we don't trade late night. And we trade during high volume periods. And the only other thing I wanted to say is that day trading today is so much tougher than it was 10 years ago. 10 years ago, there were multiple instruments that traded with huge volume. The Russell was on the CME. It traded 250,000 shares. The NASDAQ traded 250,000 shares. And you could get great trades on ZW, on wheat, on corn, even on soybeans sometimes. The market opens at 10:30. I mean, you really had so many more choices. But volume on the Russell is dead. Volume on the grains or the agricultures are dead. Volume on heating oil is dead. Volume on natural gas is dead. And people are really exiting the futures market. And the reason they're doing that is because it's so tough to make money. And it's become a real wheel. As less people trade, it gets harder and more people exit. We're really only down to two instruments, the E-mini and crude, that trades with any kind of volume authority. And it used to be many, many, many more. And these are the markets that the high frequency traders target. And when they do it at night, they will just run you over. The market makers will reject your stops. So you have to you have to trade during high volume periods, and you have to trade with the trend. Now, just let me see if there are any questions. No, Ron, you do not. Ron, we have tried Renko bars, and they're very difficult, but we have an indicator that will work on Renko bars. So we can have it done. Now, you do not have to have the higher time frames open. The indicator itself, background bias, based on your trading chart speed, whether it's range, tick, time, Renko. Yeah, Bobby, they do work for NinjaTrader. In fact, right now it's the only platform they do work on. We're working hard to get it on Sierra and then MultiTrader. But right now, Ninja is the only platform that it works on. So once you dial in your chart speed, the indicators based on the formula automatically calibrate the two higher time frames. And you can trade range, you can trade Renko, you can trade time, and you can trade tick. It does not make any difference. You're going to basically get the same pattern just with a different kind of chart. The analysis, though, is the same. It's the alignment of multiple time frames. Now, I'm going to show you our dashboard, and it's almost not even fair to call it a beta, because it's even pre-beta, although we're going to have it released probably by the end of the week. Now, here's what it is. You can put as many markets on here as you want. Now, what we're going to do is we're going to split them off so that bonds will sit by itself. Notes will sit by itself. Gold will sit by itself. We're adding volume. We're removing the 50 because we don't care really pretty much about the direction of the 50. We're putting in an alarm, and all you have to do, like I took it off of natural gas. Now remember, bonds and notes almost always move in the same direction. So you can trade off of an alert. When the quant lines are green, when background bias is green, when the modified 15 is green, and you get a beep, all you got to do is grab the chart, swing it over. Let's take a look at notes. See, it's just not working because the market's dead. But all you got to do is pull the chart over and take a trade. Now remember, we don't trade indicator confluences. We have to wait for an optimal signal. But when you get all red or you get all green and you get an audible alert, the likelihood of getting a good trade is high, because that's where we get an alignment of multiple time frames and our correlative markets are all moving with us. And when our line 15 or the modified 15, like here, is moving down with the trade, we hope we're going to get a very, very high probability winner. Now, we can put this on as many markets as we want. Right now, the colors are not completely accurate, and putting it into one configuration like this, too many colors, too much movement. It's too difficult to trade in the morning. What you want to do is take each individual and move it over that chart and wait for an audible alert. And it really, really gives you great trades. And let me show you a dashboard trade that you could have gotten off the dashboard easily without having to watch the chart. Now, we don't have background bias on gold either, which really, let me see if I can get it just by, I like gold, but gold, you really have to be careful. Here, we got it back. Right here is a dashboard trade. You have the Quant Line, whoops, and you can program the audible alert to go off on either dark green, whoops, or dark blue. This dark blue, the cyan color, I think, is also very strong. And you get a dashboard trade to the upside, retracement, and another trade to the upside, and you have two winners. And you're trading them at the most conservative manner possible. And you can see how these multiple time frames aligned to the upside just keep pulling gold higher and higher. But we can't take this entry. It's on a yellow modified 15. It's you can take it as a double bottom, but it's very tough. There's no entry here. And then gold starts to consolidate and it moves even higher. The point is we're trading into a strong trend. Here's where we get a great dual area of support, the value area high and the modified 15. This is just a nice retracement. The candle entry is engulfing the previous candle. We'll like to see that. And the continuation to the upside. And we've got every single independent variable going for us. And we could get this trade easily just with an alert from the dashboard. We stay with the ES and we stay with crude and we don't do anything until we get an alert from the dashboard. I'll show you another one. I mean, they just come up over and over and over again. And right here. Dual quants. The move down. The retracement. Remember, quant lines are really strong on bonds. And bonds are $31.25 a tick. This 4-tick trade is a very lucrative trade. Now, could you take this trade? I wouldn't have because I'm kind of allergic to risk. And you only have one quant, and I want them both on bonds and notes because there's so much money at stake. Here's another one. Already have the blue line attached to it. Dual resistance right here. This is your audible alert. Plenty of time to get into this trade because the audible alert is going to occur here when the background bias turns dark red, dark pink, and you get dual quants and you get the modified 15 red. So you see the first setup is right into the value area low and it breaks it. But then it retests it and down you go. So it's signaling that there's a nice trade potentially coming. You let the first entry go. You don't want to trade into it, into the VAL. Wait for the break and retest and down you go. That's the advantage that the dashboard gives you. It gives you the ability to leverage this system on multiple markets without having to watch them And that is really a gigantic advantage. Now, eventually, we're going to roll it. I show all my trades in the live room, Ron. The bad ones and the good ones. Everything we put in the live room. And we use Chart Trader. You see the Chart Trader right here? The P&L is flat only because we closed and opened and the session's over. But this morning we made $485 in the live trading room. And we show our targets. You know whether we have a fill or we don't have a fill. And the number that we use and that we post on the website is exactly the number you get on this P&L minus commissions. We assess our trades $4 per round trip per contract. So on 4 contracts, we'll subtract $16. One contract, we subtract 1. And if I don't take the trade and I miss it, we don't count it. Now, here was another trade. This is riskier. And this is a break and retest. Let's move to the right edge to see where we were. Boy, that was a risky trade. I'll tell you. I had a lot of Kilyonis on that one. But that one broke right through the value area low and went 7 ticks. What I was looking at in retrospect was this trade, and this trade, which I did not take. And I think it's always important to go back and make an assessment. And look, here's a perfect trade. I took it 905. That failed. Right here. I mean, I think maybe I took it too close to the E-mini open. I can't think of any other reason, but not every perfect trade wins. And here's a great example of a full loser on the E-mini right here. You have all the correlative markets. You have a very, very conservative retracement and every expectation that the market will continue. But you see what happened? The next candle, all the quant lines rotated to green. And the market reversed. And that's going to happen sometimes. Then I looked at this trade, which I did not take because I was worried about the value area low. It broke it and went through. And so this is just unfortunate. Sometimes a great trade doesn't work. But when that happens, it's just no big deal. Not every trade is going to be successful. Here's a 3-tick, a little riskier. Here's 6. Now, I have a very specific counter trend setup, but this was a counter trend trade, and I almost never counter trend trade. That's the only time I will do that. So really, that's really the system. This trade went 19 ticks. And let me tell you, it came back. It was a riskier trade. I only had 1 quant. I had no background bias. But let's go to the right edge. It came back 5. I like the fact that the 50 was down, the 15 was down. I had faith in my 1 quant, and it pulled the market down. And it went down 19. In retrospect, I wouldn't have taken that trade over again, even though it was successful. And here was a trade that I took on a yellow modified 15, a terrible trade that went to, one more would have given me a first target, and that was a loser. And 99% of the time, when I take a loser in the live trading room, it's my error. Because you never want to trade long when you have a red quant. And I did it anyway. And I deserved to take a loser. I just liked the up channel. And I liked the fact that I had dual support, the point of control, but just too much. The modified 15 was yellow, didn't have a nice trend. So really, the cause of most of the failures in the trading room are me. And this is just going through trades in the room. So I think everybody gets it. I don't want to take up too much of your time. What we're looking to do is we're not looking to trade indicators that analyze data from your trading chart. They have no predictive value in determining future price movement whatsoever. We want to look at the correlation of multiple higher time frames and the correlation of multiple markets that either move in the same direction or the counter trend direction as the market that we're trading. And we look at market profile. It's very important. Value area high and low and point of control are excellent areas of support and resistance. We stay away from them. We let the market break it and then retest that line, and we get great trades. We look for consolidation. Trade out of consolidation. I was scared. I remember this trade. Well, this is at 2 o'clock in the morning. It must have been a trade like it. But I don't like to trade a candle with only one tick of candle body. I don't think that's a lot of selling conviction. I like to see 3, 4 ticks of candle body. But you can see the signal out of consolidation here. These trades out of consolidation are just great. And there's some days where we just don't get them. That's as far as it goes back. And some days we'll get multiple signals. Let me just make sure this goes 10 days back. Yeah. And what the dashboard's going to allow us to do is to leverage the system on multiple markets that we don't have to watch. We just have one chart up, wait for the audible alert, which we will configure for you in any way that you like. I know what are the powerful quants and what are the weaker quants. On bonds, you want both quants, and you want the light, the cyan, or green background bias. When you get it, and the 15 is the color of your trade, you get an audible alert. It's not an entry. It's simply an alert to pull the chart up and take a look. And I don't think you're going to get many audible alerts throughout the course of the day because you need so much to align. Now, we have a whole bunch of charts that right now, because the system isn't exact, I've taken them off. I've taken them off the NASDAQ. I'm going to wait until we can break it up and I can put my dashboard right above the NQ. I've taken it off natural gas. I want to wait for that. I want to wait to be able to break it off and put it right over NG. And then I'll program it for a signal, an audible alert. And what we're going to do is we're going to have, besides the audible alert, we're going to have a color here that you can decide what color you want. And the color will also go, let's say your audible alert or your trade color, you want to make magenta. The audible alert color will go magenta. So just with a little glance of your eyes, you can tell not only audibly which market is a great trade market to trade, but also visually. And you can pull that market up quick. And you're not going to, it's not like that beep is an entry. That beep is a signal that an entry is likely to come. Now, what I would like to do, and remember, in the trading room, I show everything. I mean, when I trade badly, you see it. When I trade great, you see it. And 99% of the time, if we have a poor day, it is me, because these signals recur over and over again, and they occur in the direction of the multi time frames, and they occur in the direction of the quants when everything aligns. So what we're going to put in the room right now is a link for a free trial so that you can come into the trading room. You get 3 days in the room, and I would really like you to watch the system in action and come in. Don't give us any money. Don't buy anything until you see how we work, it works, and how we use it on a live market. And that was really the purpose of this, to really show you how we trade. And if Rory can put in, let me just grab Rory for 1 sec. Okay, so Rory put the link in. And all we would like you to do initially is to come in. I think you will love the system, and I think you will be very impressed with it. It's unique, and it's not like very many trading systems out there. They all do the same thing. Oscillator, MACD, all from your trading chart. They put in Fibonacci, and 95% of the traders are using them, and 95% of the traders go broke. You have to break away from the pack and ask yourself, why does such a huge percentage of traders bust out of the market? And I'm telling you, that's the reason. They're using indicators that don't predict future price movement. Stay away from those systems. So that's it. If you have any questions, we'll be in the office for a little bit of time. And I hope I will see you in the trading room tomorrow morning. Tomorrow is Wednesday, and we get natural gas. Crude oil inventory. I try to get a great trade off of that. We got that 16 ticks right on the open of the crude pit. We're always looking to leverage the system in our direction, and not to take risky trades. And that's the name of the game. So listen, everyone, thank you so much for coming. I really appreciate it. And again, come on in and kick the tires and give us your feedback. And if you have any questions, you're welcome to call us. And no matter what you do, I mean, we really work hard to make you profitable. I mean, we consider you to be a part of our family. If you buy our systems, all your upgrades are free. We don't charge you for, we really don't charge you for a lot of things that many other people do. We have great tech support. Someone's always here to help you configure, and we configure your whole system. The dashboard, the indicators, everything. We also have an algorithmic system that takes the trades that I showed you. It takes it automatically. So if you don't have the time to sit in front of the computer, the algorithmic system will do it for you. So that's it. Have a great evening. I wish everybody, everyone that tries to do this, I really wish that we're all successful. We're all the commercial traders. We're the little guys here, and we can't beat the institutions. We got to beat the other little guys, we can't beat the high frequency traders. We just really have to trade with all of them. Run over the counter trend guys, run over the guys calling the tops and bottoms, and stay with the trend. So everyone have a great night, and hopefully I'll see everybody in the trading room tomorrow. Take care all, and thanks again. Thank you guys. I appreciate it. Bye-bye.